Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach.
Oh no.
It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Whew. Okay. Man, that is going through straight to the bones.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Fast Market right here on Schwab Network. So we want to focus on AMD. Citi adjusted the price target for the chip maker to $248 from $260, but kept the buy rating. The analysts added an upside 30-day catalyst watch on shares heading into the first quarter report. Now, the firm sees this upside consensus estimates on higher central processing unit demand and pricing from agentic AI use. So lots to discuss there. Let's put it all together. I bring back the co-host, Tom White, Kevin Hanks, the stars here today of this show, because they're going to go back and forth on AMD. Kevin, you're first up. Your thoughts?
You know, here's the good news. I could give you a bunch of letters and new products and all these things, but the big story, I think, is AMD is really starting to compete with NVIDIA. And they're getting closer. That doesn't, you know, NVIDIA has already made adjustments to the Rubin chip that is identifying the competition coming from AMD. So the good news for people that want to buy these chips is there's more, you know, there's more. Now, all these stocks, NVIDIA, AMD, Broadcom, they've all struggled lately, right? In their prices, despite everything glowing about doing nothing but getting better. NVIDIA keeps talking about how strong demand is, and we're still in the early stages. But make no mistake, these stocks have struggled. Now, if you look at AMD's chart, it's a pretty healthy looking chart. It held that, you know, that 185, 190 level a couple of times and has firmed up and is now back through the 50-day moving average. It looks like, I'm no Ben Watson, but I think he would say that it looks like that this stock is starting to break out here. So it's certainly something worth watching. It's got earnings coming up May 5th. I think that's what the letter mentioned as a short-term catalyst. Could be a big number. You know, you should watch all these for upside as they release earnings, Nicole.
Yeah, I mean, to the point of seeing the surprise in chip demand. I mean, for example, NVIDIA today, I was talking about that with Stephen Orr, and he said, look, I still really like it a lot because I bought a computer and I had to buy 2 NVIDIA chips. And so with the surge in chip demand, which comes as a bit of a surprise, Tom, AMD may be positioned very well for this.
Yeah, but I think if you take a look at it, you know, the stock's only pulled back about 17% from record highs. We've seen that consolidation in NVIDIA. Their growth rate's a lot better. AMD's still got a pretty high valuation at this point. Now, their CPUs, where they're taking market share away from Intel, they're hearing rumors out of the Nikkei news source over in Japan that they're going to be able to raise prices 10 to 15%, maybe more on CPUs that are going to be used in inferencing, as opposed to the build out of the GPUs. So that might be a bonus for them. Also, we've seen what that's done in the memory chip segment, where their increased pricing is improved margins and valuations for those companies because demand is so high at this point. So that would be a positive here. You think you have to,
it's 20% of the profits.
The optimism on these names, because we've seen fits and starts in the chip names, even though they're at the forefront and they're the picks and shovels within AI and other parts of technology. It just feels like, hey, the stocks still had a great run throughout 2025. but still, relatively muted and starting to consolidate, maybe breaking out just a little bit above a key 50-day moving average for AMD.
All right. Thank you for that, Tom. Kevin, you want to start us off? You have some example trades. Let's check them out.
You know, with a stock that hit a high of $267 not very long ago, just the end of October, 3, 4, 5 months ago, if you're looking for a paper money trade that might give you upside exposure, what I did, they have earnings coming out on May 5th, so I stayed ahead of that. I went to the May 1st expiration and just looked at something. If you look at the May 1st expiration, the expected move, about $26, right? Almost $27. So I lined up about a $30 call vertical, buying the at the money, buying the May 1st 220 call, and then selling the May 1st 250 call. Still under the all-time high, but certainly a recovery, identifying that breakout on the chart. If that's real and that keeps going, I don't know if it is, but this is a bullish play. It's a $30 call vertical that you're spending, about $10 on, probably a little less than that. Yeah, it's probably about $9.80 now, but this is a risk-defined way with a chance to triple your money if AMD heads toward $250. Tom, if this breakout is real, this is one that gives you about 34 deltas on the upside and a chance to, like I said, triple your money if it were to go towards $250 in the next 25 days, Tom.
And that $220 price, which we're sitting right at, has been an area of resistance since that fall from last earnings. But Kevin mentioned AMD reports on the 5th. But let's break down Kevin's trade. 25 days to expiration on this one, May 1st, weekly expiration. You're going to avoid that earnings event, but take advantage of any potential gains going into that report. Buying the 220 strike call, that's at the money. Selling the 250 call. $30 wide bullish call vertical, paying roughly $10 debit. There's your risk, $1,000. That can expand to 30 if we get above that 250 level over the next 3.5 weeks on this one. Break even, $230 to the upside. On a percentage basis, only about a 4.5% move needed to get above that potential break even of $230 to the upside.
So it's at the end of that day.
Option series, the May 1st weekly options, where Kevin gave us his example trade, plus or minus $26 move either way in the shares. So if you do get that $26 move to the upside, that'll get closer to that 250 level that you're looking for on this. But in this type of trade, you get some a little bit of flexibility as far as trade management, because if you start seeing those moves above 230, 235, 240, and you start seeing expansion of this vertical, that gives you some optionality where, hey, I don't have to wait until expiration to maybe close all or a portion of it if the market's open and you start seeing this thing expand. So it does give you that flexibility where you don't have to wait till expiration on this type of trade. But directionally bullish, you need a move of above 4.5% to get above that break even on this bullish call vertical. Kevin, I went a little bit more passive. That's a little bit more aggressive. I went a little bit more passive. That gives myself a cushion to the upside on a neutral to bearish short call vertical here. And I went to the April 24th weekly option. So a week less than yours, a little bit less duration on this one. And looked at just a higher probability of success, where I'm going to sell the April 24th weekly, the 234 or 235 call, and then against it, because we want to stay risk defined, by the 245 call. So a short $10 wide neutral to bearish call vertical. You're going to collect roughly about a 220 credit. That's what you can make, $220 per spread with $780 in risk. But Kevin, it takes your break even all the way up to 237.20 to the upside. That's about 7.5% cushion to the upside before you get hurt on this more passive trade, Kev.
Yeah, this is one of those, Tom, where your break even is about 237 and change. My break even is right at 230. So you can make a case where something between 230 and 235, both of these would be profitable.
Elastic demand means that
this one's a little bit shorter duration on that one. It expires on the 24th. But you've got a probability on that short 235
Rubber
call of
band
about
is out of
72.5% that it'll be out of the money
It's
at
not
expiration,
elastic.
which is
It's
what
not
you
a
want
snap.
on a
Okay.
higher probability of success. But that's why you've got more
I
risk
need a
than
fucking
reward, as
book.
opposed to Kevin's, where
Yeah.
Nicole, you've got more reward than risk on this one. This is a little bit more passive on the neutral to bear short call vertical.
Yeah, and it's really nice for folks here to have the choice of two. If you want to be more aggressive or more passive, you have the opportunity to choose either one. So I think it's so great how you both provide different trades on that. Okay, so AMD right now is up 1.4%. We took a good look there at AMD, and up next we're going to take a look with the team of Likefolio at the latest data, their sentiment data on Carvana. That stock doubled last year, but analysts are saying 2026 may be a little more tough for Carvana. We'll be right back here on Fast Market.
Hi, I'm Alex.
I'm Jane. And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Vardas, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network.
Oh my gosh, I haven't had a Scooby snack in years. That's a wild thing to happen.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support.
Oh, I have not had a Scooby snack in a long time.
Our team of passionate
That's
traders
crazy that
ready
this
to tackle
happened.
your trading questions.
Okay, that was a rookie move. No, Scooby snacks
Plus,
happen.
get 24/7 live help.
Damn,
and
I have a
access
pre-roll
support
J.
by phone, email.
I did check it down a bit.
in-platform.
That's funny. Whew. I'm glad Devin didn't see that. Or Francis.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome back, Fast Market, right here on Schwab Network. I'm Nicole Petalides alongside Kevin Hanks, live at the CBOE, and it's time for Cash Tags, and we bring in Landon Swan, co-founder of Likefolio, because we want to take a look at Carvana, which doubled last year. It was so hot. People, during COVID, people were buying cars without even looking at them. I mean, it's a great concept, right? Hey, there's a car for you, but at the same time, the analysts are a little worried about 2026 because the outlook picture here may be a little more troublesome for a car like Carvana. I want to hear what the sentiment data is saying that you've been studying there.
In the system.
Yeah, I mean,
but then
when you
people
look at what I think kind of
Buffett
shook Wall Street up, I think it was a bit of lack of guidance or softening or just blurriness, I think. They weren't as firm. Now, they've got some lofty goals, 3 million annual units. That's one of their goals, and they want to get their adjusted margin up to 13.5%. I think it's 11 now. So reachable goal. The units is pretty aggressive. I think they're around 600,000 right now. So I think that's a 5x they're looking to do. But there's room. I mean, the market is like 38 billion units a year. So they're pretty small. They're less than 10% of the market still. But, it's an interesting, thing where, COVID really set them up well to, like you said, just kind of buy online like you'd buy anything else online. You don't have to go in and, deal with people and go through all that hassle. And I think what's interesting is we're seeing a bit of a shift over time, and it's slow, but it's pretty steady, where people are gaining comfort in ordering something like a car online, whereas the conventional wisdom is you need to go in, especially used cars. You got to go in, you got to kick the tire, you got to drive it around the block a couple of times, see if it's making any funny noises and all that. But I think Carvana is slowly starting to earn the trust of more and more people, more and more sets of demographics. And obviously that's a good thing for the company. When we look at the the usage and the demand that
What would
they're
the
seeing,
other must
especially when you look at the
register in a
website
state
visits,
if it has
it's
a
really incredible. I mean,
office?
compare them to CarMax, and this is just an unbelievable story. This is a year-over-year change. So you got plus 68 for Carvana and minus 48% for CarMax. So these are two companies going completely different directions, and they're very different in the way that they sell cars and their model. I mean, again, CarMax is old school. They got the lot, you got the dealer. They're a refreshing change from the normal dealer where there's not a lot of
Has its
negotiation.
headquarters, I
People
guess, is
really like
different
that.
than
They
any
still
place
like that
of
a lot,
business.
but I
These
think the
fucking word
convenience
games.
of Carvana
Well,
and just the
rather be
ease
the
of
word
just
game than
anytime you want to get on, you get on 2 o'clock in the morning, whatever it is, and you can search around and you can order a car and you can have it very soon. I think that's really growing on people, especially as they get and maintain trust that when they send a car, it is good, it's in good shape. Even though it's a used car, you don't have to worry about anything. So they're gaining trust, and you can see that in the numbers. And even when you go to the line chart of the data over time, I mean, this pullback looks like a tremendous opportunity. I mean, the stock was, what, 150 a year ago, got up to almost 500, and now we're just above 300, I think 313 or so. So it looks like a complete disagreement between these two numbers, where they have been for the last 2 years, they've been in pretty good agreement. And now all of a sudden you've got the stock kind of tanking while the consumer data is still very strong. So this is a divergence for us. This is one of those opportunities that we really like to see. That, of course, they don't report for a little while, a couple of weeks, but 3 weeks, I think. But still, just even at this point, it looks pretty strong that the consumers love it and Wall Street hates it. Our data supports that narrative just across all metrics. And so I'd say that Likefolio is fairly bullish on Carvana at this point.
Landon, I think there's two really important topics when it comes to Carvana. You mentioned one of them, their competition with CarMax. If that was a fight, it'd be stopped, right? Because CarMax has 250 locations, old school car sales, where Carvana's all online, and that's a product of the miserable experience that buying a car is, right? Up until you drive it home, it's a miserable experience. There's the one that really favors Carvana. Then there's the other one, which I have friends in the car business, and they have no idea how Carvana can make that much money per sale and that much margin. They said it doesn't make sense that you can buy a car, a used car, and sell a used car for that type of a gap
This
consistently,
creates jobs,
right,
puts
with those
money in
margins.
consumers'
So
pockets, and helps
there's the two
restart
things that
economic
we have
growth.
to deal with. But in terms of their
Keynesian
competition with
demand
CarMax,
side
it isn't a competition.
increase
It's a
government
beatdown.
spending
And
in
it
recession
shows you, I
reduce
think,
demand.
the evolution of buying. That's everything from Amazon to everything you buy online. It's now getting into the car business, Landon.
Yeah, I agree, and I will say there's a giant
Nice
asterisk
bow
on
wow
everything I
on the
say today.
shorts
A
again.
caveat that we assume that everything that
Hey,
Carvana is reporting
why
is
is
on
he
the up
on
and
a
up. I know that's
plane?
been a bit of a narrative, and I get it. I mean, I'm not in the car business, but some of their numbers, they're head scratchers.
Investment
But when you
advisor
think about
recommends a
the lack
protective put
of real
strategy
estate,
to
the
a
lack of
client.
employees,
The primary
then I think you
purpose
can
of the strategy
maybe
is
start to
to
figure out how the numbers on each car makes more sense. And really, it's
protective
almost like
put.
Carvana is like a logistics and a software and a finance company that happens to sell cars, right? I mean, when you think about a company like Amazon, they're not so much a retailer as they are a technology and logistics company, and that's what makes them so good at what they do. And I think that Carvana is kind of that for car sales, and so they've reinvented the game. They're kind of 2.0, and honestly, CarMax was kind of a reinvention, like I talked about earlier. People hated going into used car dealers, and CarMax changed that experience tremendously.
Protective
they
or
gave you the
protected?
7-day return policy, the no
Because I
haggle,
thought like
the no
there's
haggle
covered
pricing, and
calls
all
and
of
then
that.
there's a
And that was a big
protected
upgrade for a
put?
lot of people, and I think Carvana is just saying, all right, well, that's
Hint.
good, but let's make it great. Let's completely just take that sleazy guy out of the equation. Now it's a website. What car do you want? Let's order it.
Protective put strategy involves
Again,
ownership
assuming
of
that the
stock
numbers are all on the up and up, then
simultaneously buying
this
and
is
put
this
off.
is
Okay,
a big shift between what we would say Main Street versus Wall Street. In fact, when you look at our Main Street score, and that is what do consumers think, we've got an 85 on that one out of 100. The Wall Street score, what do investors think, that's a 23. So there's a massive disagreement between consumers and investors on this one, and that's what I think sets up the bullish opportunity, again, with that caveat that I keep mentioning.
I think I could think this one through.
Understood. Is there a seasonality to this? So if, like, Folio's a little bullish on Carvana, maybe these analysts are being a little too cautious. Right now, the stock's at 316. I did see some price I saw 360, I saw 430 and 335. So most of the targets are higher than where we are now. But of course, the language is a little nerve-wracking, right? They're talking about the headwinds and whether people will spend. Is there a seasonality? Spring, summer? Are people buying more cars, maybe?
Yeah, it's down in the winter, generally speaking. You can kind of see that in that chart data. I mean, I think, just generally speaking,
I think that was the
reason
fastest
people don't
I've
like
ever
to buy
gone to
cars
that
in
one.
the winter. I would say that they don't like to go to the dealerships because it's cold, but they're not, it's a website, so they don't have to do that. So maybe it's just they're spending on so many other things that cars are lower on
Under
the list.
federal
But
tax
yeah, I mean, it's somewhat difficult to spot seasonality in the chart that we've got on their demand data because it's so much up and to the right. There is some dips and valleys and peaks, but yeah, I would say that as you can see, within a given year, the winter is a little bit lower than the rest of it, but that's an up and to the right kind of chart, so it's not easy to spot.
Once per year, probably.
But yeah,
you gotta be serious, and we can't be
just overall, when you look at this company, the consumers absolutely love it, and there's so much room for growth. I think that's the other thing that a lot of investors get excited about is, even if they're under they're about 500,000 units right now. They're looking to go to 3.
Why does that say twice per year?
Almost 40 million a year. So there's so much growth, and it doesn't just all come from CarMax. It comes from all kinds of places. They're going to pass CarMax in 2026 in number of units sold, and then they're going to set their sights on the next one. So, this is a case of, I think, people getting more and more comfortable with this way of buying something that it's almost like the last thing that you would buy online. Like clothes are kind of there. You want to try them on. You want to see how they look. Used cars are one of the last things I think that someone would buy online right after maybe a house. And so the fact that they've been able to tackle this and get people comfortable with it is a big testament to them. And the more people that get comfortable and tell their friends and say, you know what, I bought it on Carvana, I saved money, it was easy, I got it the next day, it works great, no problems. The more people are going to start saying, yeah, why am I going down to the lot? I can just look online, and what I see is what I'm going to get. And I think people really appreciate that. And again, the data is screaming at us that the consumers love this on a year-over-year basis, and the analysts and the investors hate it. So we love that disagreement. I think that's a big opportunity.
Financial health, earnings, ratio,
Landon, I also think it could be generational because I think about my uncles who like to go in and talk to the guy and haggle and all that. Versus my sons that are, 20, early 20s, I think they would much prefer just click and buy. They don't want to haggle with anybody. They just want to know what they're getting, and that's it. So maybe there's also a generational thing happening here, too. We have to wait and see. Landon Swan, it is great to see you. Thank you so much, co-founder of Likefolio. Landon, thank you. Let's bring Tom White back in as well. Tom, what were your thoughts here as you're listening to Landon being a little more bullish on Carvana,
added value.
while some of the analysts have been cutting their price targets? Your thoughts?
Yeah, since about 3 years ago when there was all these rumblings that they was going to go bankrupt, they had a lot of debt on their balance sheet. They're paying that down. Growth rates really strong. They're eating the lunch of all their competitors at this point. But valuation's still pretty elevated compared to its competitors. So that, we had that Bank of America downgrade in there today.
Yeah,
so that's the things that you have to start looking at. Full disclosure, I sold a car on Carvana, and it was a really easy experience, and I'm not that younger generation, Nicole, as you know. But Kevin, when you look at this, the stock has pulled back pretty significantly from those recent all-time highs over the last 2 months, basically. We're off about 35% from those levels. How do you want to look at this one from an example trade?
Yeah, Tom, I'm looking at this level where we find ourselves. And again, they have earnings on April 29th. So again, what are we doing? We're staying ahead of that earnings. I'm trading in the April 24th. And what I did here, very similar to what you just did in AMD, which is the high probability short put vertical. I went in, I looked at the April 24th expected move, about $40, Tom. And so I went a little more aggressive inside that, and I sold the 285 put in the April 24th, bought the 275 put. So a $10 wide, a little bit more aggressive in the closer to inside the expected move. It was trading 235. The stock's recovered a little, it's trading closer to 220 now. But this is still a high probability short put vertical that is collecting theta on a daily basis. And of course, as always, it's risk defined, Tom. So the risk on this trade is the widths of the strikes, in this case $10, minus whatever credit you take in. If it's 220 or 230, it's $10 minus 230, about 770 is the risk on this trade. So looking at it like that, you don't get the big payout, but you also have a much higher probability of being successful, Tom.
Yep, let's take a look at this one. 18 days to expiration on this one. Same April 24th weekly option series. Kevin selling the out of the money 285 strike put, buying the 275 strike put, short $10 wide, neutral to bullish put vertical on this one. Collecting roughly about a 235 credit, as Kevin mentioned. The credit you collect is what you can make with about $765 in risk if you collect 235.
I'll do that later.
I think one of the keys on these passive type of strategies, you start looking at those probabilities of finishing out of the money at expiration. Now, recently the stock has bottomed out around 285, touched below there a couple times, but then bounced back. So if that level comes back into play, does it remain above 285? That's what you want. That break even 282.65 to the downside. You've got about a 70 or 69% probability that that short 285 strike will be out of the money at expiration, which is what you want on these high probability trades. And we talk about this, the trade-offs. You're risking more to make less, but you've got a better probability, better odds of success on this type of strategy where, hey, the stock can still fall. As long as it remains above 282.65 to the downside, you can be profitable on this trade. 18 days to expiration on this passively bullish trade here, Nicole.
All right. Thank you both. Amazing, both of you. Tom White and Kevin Hanks, a good look there at Carvana, which right now is at 315. We continue our wall-to-wall coverage here of some of the names that are important here today, including George Sillis will come up next. He'll have a breakdown and discuss Seagate. Morgan Stanley naming this stock a top pick in memory. Find out why. Fast Market will be right back.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com
and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast
that one's
that's
funny.
right for you.
Okay, I was about to think, is it Form 4? But then I had to read the whole question down.
Platform features
Read
and
the whole
resources
question.
available from Schwab.
Under
You'll
Rule
learn tips and
144.
tricks to help navigate Schwab.com,
Let's narrow it down.
and mobile-based platforms. Best
It's
of
funny, I
all,
was almost
you
2
can
in the
ask
zone.
questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
I know this one for sure. 70%. 10 are unscored.
All right, it's time for the breakdown. Seagate hit a new all-time high today after Morgan Stanley named the stock its top pick in memory. So the analysts raising the price target to 582 up from 468 after its latest checks showed that hard disk drive demand continues
that makes
to
no sense because I made
there were a lot of little
savage
pinpoints
pizza
within the
last
report.
night.
Pricing
And
power,
that's why my
demand is
stomach
hot.
was
Senior
all
markets
messed up.
correspondent
I
George
had to get
Sillis is with us. So take a close look here at Seagate, which is really seeing some nice moves here today. Some of your thoughts here on these memory stocks and this name in particular.
Well, I mean, yeah, first off, to mention the price action, stock did gap higher, actually breaking out of a previous resistance area. It's pulled back a little bit alongside the markets, but nonetheless, interesting how, a lot of these names in the solid-state drive, hard disk drive areas, as well as cloud storage, have actually been just remarkable trenders over the last, 52 weeks. That includes Western Digital, SanDisk, Micron, which has pulled back from its all-time highs. But nonetheless, when you look at these names, enterprise storage has been a key ingredient and a driver, both on a secular as well as a cyclical standpoint, Nicole. And if you look at Morgan Stanley's call, they upgraded the stock to price target now, 582 from 460. They maintain an overweight rating. As you mentioned, it's a top pick for technology for them. They just see the demand just continues to strengthen. If you look at the supply shortages as denoted by the company, they see the shortages still going on until 2028. They see firm pricing power through 2027. Order backlog is a record for the company all the way through this year, 2026, as well as the fact that margins are over 40% on a gross basis for Seagate, which is, again, historical in nature because typically these names, of course, Western Digital, SanDisk, Micron, for instance, are deeply cyclical, and they have trouble maintaining pricing power. But what Morgan Stanley's looking at, and I think they make some good points here, is that the cycle is elongated. Because typically the cycle for these technologies is around 6 quarters, but we're talking about through 2028. This is a very long, elongated cycle, and I think that's important in the context of the hyperscale demand. Enterprise demand, server and markets are high, and even consumer products are in high demand for traditional solid-state drives, and that all encompasses Seagate, including Western Digital, which they still also maintain a very positive outlook on Western Digital as well. Both these companies, interesting enough, are trading very similar, parallel with each other. Both in valuations, but also in price. And if you look at Seagate, Nicole, too, valuations right now, 32 times this year's earnings, 21 times next year's earnings.
I'll turn my goddamn mic off for that.
In growth, 83%. So one of the things I'll point out again is that if you look at Micron, Seagate, Western Digital, for instance, they're trading at very low earnings multiples compared to the growth rates. And I think that's the market even giving them a margin of safety, considering, again, there can be some additional supplies brought forth in the market from some of the Korean manufacturers or even China, which is another dark horse, competitor out there that could bring a lot of supply to the market and quickly erode margins. But nonetheless, again, these are trading at very significant discounts to those earnings growth. Again, just to mention, 21 times next year's earnings with 83% earnings growth. That's 4 times earnings growth, or 1/4 of the earnings growth. So typically, a PEG ratio 1 is considered deep value for a growth stock. So this is significantly below those levels.
I'm not sure if I can hear it
George
that much.
Sillis, thank you for that. I really appreciate it. And I know you'll want to listen to Tom and Kevin, too. And the truth is, the big picture, what George was saying, gentlemen, it was that, and we put this in our Inside AI series on SchwabNetwork.com today, is about the demand profile and how it's creating tighter supply, stronger pricing power, and a longer runway for earnings growth in the space. So I wanted to get your thoughts and your example trades. Kevin Hinks, Tom White, both back with us. Tom?
Yeah, you take a look at this. I mean, the stock's up, what, 535% over the last 12 months? Yeah, it's like a hockey stick, this chart on the stock. And you look at, who thought we'd talk about hard disk drives, being, at the center of the AI infrastructure build out, but they're being used in the inferencing side, and they continue to grow earnings. Demand remains robust for the next couple of years. So I looked at a strategy in here that, don't be a hero type of strategy where you can still take a directional bias on a stock, but even after a spectacular run like this, you want to stay risk defined. This is a high price stock. It can move pretty significantly. You mentioned it hit all-time highs today. So sticking with that passive neutral to bullish strategy, went out to the April 17th monthly options that expire in just 11 days. So shorter duration on this one. Where I'm going to sell the out-of-the-money 420 strike put, and then against it, buy the 410 strike put. So short $10 wide, neutral to bullish put vertical. Collecting roughly about a 240 credit. That's what you can make, 240 bucks with 760 bucks in risk. But Kevin, that break even on this one over the next week and a half, down to 417.60. That's over 8% below the current share price. So we go back to that trade-offs, right, on this type of strategy.
Yeah, this show has turned into a real vertical spread seminar here because long verticals, short verticals, probabilities on these trades, and the fact that, let's face it, three things can happen and you can still be profitable. The stock could stay here, the stock could go higher, or the stock could go lower but not hit that short strike. All those, even you could be wrong on and still be profitable on this trade. So I think this is the way that people should look at these trades, right? There's a more aggressive one that needs a move. There's the short vertical that is more passive and doesn't need a move. It answers that question. What if nothing happens? Well, the long vertical is not profitable. The short vertical is profitable, Tom. All these trades risk defined. It's the width of the strikes minus whatever credit you take in.
Yeah, you make a good point there, as far as how aggressive you want to be, what your risk tolerance is on these strategies, your time frame or duration all matters. Those guidelines that we take a look at on this passive short put vertical here, if you're bullish or at least neutral or maybe even a little bearish here, Nicole, where you can still be profitable if the stock falls. You just want it to stay above the short 420 strike on this short put vertical.
And thank you both for that. And, as we see the demand, that's why Micron, Seagate, Western Dig are all back in the analysts' good graces with some upgrades today. Thank you both here. Fast Market, Tom White, Kevin Hinks, and me today, and I'll see you tomorrow as well. We're so glad you're with us here on Schwab Network every single day. This is Fast Market. I'll catch you at 2 p.m. Eastern Time for the watch list, so join me then. And coming up next, Next Gen Investing. Stay with us.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey, Pop.
Hey, Andrew.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim's my financial consultant. I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Live insights, actionable data, and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at SchwabNetwork.com.
Welcome to Next Gen Investing. I'm Jenny Horn alongside Alex Coffey, and happy Monday as we do start off another week of trading here on a pretty bright spot. We have seen consistent strength at least hold throughout today's session so far, as we are right now awaiting some hopeful tensions easing overseas, as of course markets do await U.S. and Iran a potential ceasefire. But obviously a lot still in flux there, and markets only modestly higher here, up about 0.3% in the Nasdaq and S&Ps. Dow up 0.2%, and Russell actually 2000 also up 0.3%. So a very even day of strength to kick off this week, Alex.
Yeah, and definitely something that could change quite dramatically in the next, several minutes, as I believe the president is scheduled to basically give off a press conference at 1 o'clock Eastern. Well, I just checked the clock. It's 1:01 Eastern, so it should be kicking off if it hasn't already within moments. And so certainly headline potential out of that in both directions. Can be disappointing then positive. It can be positive then disappointing. But as long as we're getting news on this conflict, expect oil to be volatile, expect the market to be volatile, and one of the biggest sources of the news right now is the U.S. president.
Yeah, and you're absolutely correct. As right now, I do see that this press conference has kicked off, but it does not appear that the president has begun speaking yet. So I'm sure we'll be watching markets react here in real time. We'll be following along to see if there's any further development, of course, from our own country on some potential catalysts overseas. But we will be awaiting that news really as it comes out. But throughout the next hour, as always, we'll focus on some more of these individual stock stories. We'll kick things off with several movers to keep on your Monday radar. We'll also be assessing some key technical levels to watch in Caesars Entertainment and Las Vegas Sands, as well as 2 ways to trade these hospitality and casino-related stocks. We'll also discuss tax season with bigger refunds expected this year, but higher household costs could offset some of these new tax breaks. And for under 30 today, looking at a big winner, Fubo shares taking off on news the company expects to be cash flow positive by fiscal 2027. So wide variety of equities to get through. We are right now in a very earnings light part of the overall season, but we do get earnings at least really starting this week. Wednesday, of course, we do get names like Delta, and then next week is really that full swing of big bank earnings. So until then, lots of various analyst calls, and that's really where we'll start here as Tesla garnering some further analyst development today, and it's not very positive, I will say. JP Morgan reducing its estimates here on Tesla. I mean, and overall just highlighting the fact that we saw not only just weaker first quarter deliveries, we saw their energy storage installations pull back about 15% year over year. So they actually kept an underweight rating on shares, a $145 price target, which obviously substantially lower than where we're currently trading.
Yeah, and it's sort of retraced now fully sort of the breakout point of the middle parts of last year, Jenny, when you look at Tesla trading sub 350, so certainly a new year-to-date low. But this is really kind of back into that area of consolidation that you saw for much of the first half of last year between, kind of post the recovery where, of course, it bottomed out in like the low 200s, even below that. But it spent a lot of time between like 275, 280, and like 365 or so, kind of chopping around before ultimately breaking out and setting those new highs near 500. Well, we're now kind of comfortably back in that range. So, technicians may look for this to be an area where buyers step in, but you may kind of have found it if it continues on this trajectory where it's sort of just, it's broke back into that channel and it kind of hangs out there for a while, technically, until we get more answers on the trajectory for this company, especially with the clouding uncertainty of what a SpaceX IPO, which is looming in the summer, might mean for Tesla investors.
Yeah, and I think also that's such an important point because I know that the notes today from, Goldman also was another one with a note out, 375 price target though, a bit more optimistic than of course, 145. But all that to be said, I do think that the right now ability to trade Tesla and say it has nothing to do with like SpaceX or Elon Musk's other entities, it's impossible to make that divide because frankly, yes, we pulled back on delivery news last Thursday. However, I do think that the SpaceX enthusiasm has definitely brought Tesla back into the conversation, but I will be curious to see if that actually adds a risk to another trading vehicle instead of just seeing Tesla as this like pure play into Elon Musk right now.
Well, certainly at the very least, if you took all variables out, it gives you another way to be invested in Elon Musk.
True.
And so just that alone, if we think there's a finite amount of money that wants to be allocated in that fashion, well, does it make more sense then to split that investment, especially if you have potentially, a nice profitable position in Tesla, set aside again, maybe tax implications that different investors may have, but say you were comfortable rotating out of some of that position, a natural potential home for some of those investors might be, hey, I'm still invested in Elon and the team at Tesla, essentially through this team at SpaceX in sort of these futuristic investments.
You're right, and that's actually a more positive way to spin it. Another very investable way to obviously have exposure to Musk and further space development because really I know that there's various types of space companies, but nothing truly to the scale of SpaceX, which is why we're looking at nearly a $2 trillion valuation per some updated Bloomberg estimates. So
which is bigger than Tesla.
Yeah, and would be the biggest IPO by a mile. So that will be very interesting to see how that obviously does actually go public because right now these valuations are eye-watering just per at least overall estimates. But to move into our next name today, which is in definitely the broader automotive space, Carvana, actually with a more negative analyst note, though, as B of A did downgrade shares to neutral from buy with a reduced price target of 360 down from 400. They mentioned the stock's near-term risk and reward looks balanced amid these recent macro and industry headwinds. But they also went on to say that the recent spike in oil prices pressuring lower and middle-income consumers and two-year rates moving in opposite directions, they view, again, things just as more balanced as we reassess some trends into 2026. And so Carvana, while it was at one point an unstoppable force, has met some resistance this year. We've pulled back almost 26% in 2026. And we've pulled back another 36%, nearly 36% from highs, while also still remaining 72% higher on a year-over-year basis. So a great example of how time frames can really depict very different messages, especially when it comes to a name as volatile as Carvana is.
Yeah, and it still, trades at a tremendous premium to, let's say, a CarMax, which is operating in the space at a larger scale. CarMax, for example, is about 16 times forward earnings. You basically got to go, 2.5 times that to get to Carvana's forward earnings of around 43 from a multiple standpoint. But I don't think there's a ton I need to add. I think Michael McGovern basically nails it when you look at this Bank of America note. If you start playing out what is the impact from this oil shock, well, it impacts those who were in that sort of lower and middle income far more than those who are above that. And if you were thinking about buying a car and you're not certain and your budget starts to get squeezed, makes sense. You're probably going to hold off on that, and that's going to directly impact companies like Carvana.
I know, and I will say that with the rising price of gas, it definitely does not make you eager to be making these big ticket purchases like buying a new car right now. At least as far as my carless self is concerned, I am not in the market at least anytime soon. But next name today, Twilio, which has been actually a clear point of strength today, up about 1.6% on the session here. And Twilio, actually a really interesting story, but the analysts know upgrading shares at Jefferies to buy from hold. Price target was raised to 160 from 125. They said that Twilio is moving up the stack to capture the voice AI premium, citing greater conviction now in the role that they will play in this broader voice AI technology stack behind this upgrade, saying that even a slight increase in traction can serve as a sustainable tailwind for the company's profitable growth profile for years to come, and also drive some upside to consensus estimates. And so they said that their greater relevance in agentic AI is right now, plus better fundamentals, can lead to a significantly higher valuation multiple. I think it's interesting, though, you look at the financial profile of Twilio over the last year or so, we've seen more consistent profitability, which is huge, and also, just more consistent financials. However, if you look at the longer-term picture, because I was looking at this name earlier, we are a far cry away from all-time highs. We're about 71% beneath this name, which peaked out at like $457 a share. So it's been a substantial long-term repricing, but depends on, again, the time frame that you're assessing things.
Yeah, and I was just trying to look at, sort of the breakdown here of Samad Samana, who covers this stock for Jefferies, because if you look at the stocks in the coverage universe for this particular analyst, it's kind of an interesting bunch of names. Zoom is in there alongside Twilio, but also you have like Paychex, ServiceNow, Shopify, ADP. So it's not your kind of traditional software firms. It's ones with like direct business use cases. Toast, for example, is in there. So kind of I don't know that I perfectly place Twilio amongst those peers, but I kind of get what they're trying to do here. But for the context, this analyst has 14 buys, 8 holds, and 1 sell. So certainly bullish still on many of these software names, even the ones that have a little bit more direct business impact or more niche kind of roles that they play.
Yeah, and I think that's an interesting list of stocks as well, because I kind of do associate them with the names that had that like pulled forward growth during the pandemic at times, and now have seen a bit of a pause, but also, saw such monumentous swings during, again, a time when we were all more, online and definitely more trapped in a world of like utilizing certain technologies. That being said, though, has at least been trying to make a recovery as of late. It just, again, depends on what time frames you look at, because this really looks different from a longer term perspective. Now, our last name today here is Paramount Skydance, which is up 3.5%. So really our standout amongst these 4 stocks to kick off our show today. And this is on news that they are now eyeing about $24 billion in Gulf backing for Warner Brothers Discovery.
Sorry, I
per some reports we got. So the Saudi Arabia-led consortium, which does include these various entities
really
like Qatar Investment Authority, Abu Dhabi's, other various holding companies.
Last a while.
They're expected to finalize this agreement, though, as soon as Monday. Saudi Arabia's public investment fund alone is set to contribute roughly $10 billion to the total amount. This is per Wall Street Journal reports we got on Sunday.
You gotta work
so the financial backing is aimed at reducing the load for, of course, Paramount's right now deal. Paramount has confirmed that the equity syndication will not
crazy how
affect its
much I lack self-control.
And the Ellison family
I swear.
is more than ready to
I have to get
full
snacks
amount
that slow me down, or else I'll just annihilate.
Overall, again, backing of the funding
I indulge so
high.
Yeah, so much.
Unlikely to at least trigger some
mandatory
reviews by the Committee of
Pleasures
Foreign
in life.
Investments in the U.S. and right
take
now
them
also
when
the
I can.
FCC. But both parties will hold less than a 25% stake in the combined company. So not the most exciting of news, but I do think also meaningful, of course, as we continue to see this deal develop and hopefully come to some conclusion once we finally get this funding, it seems like, secured.
Yeah, and this is going to start answering some of those questions that had the market so hesitant. Doesn't mean that the sourcing of the funding is going to ease some people's concerns, but it shows that there is interest and there is some deal backing.
What are they enduring?
Look, the reality is that the price tag was steep, and there was some question marks about how are you going to service that type of a purchase. So we're getting some of those answers, whether you like them or not.
And the price tag was steep. I mean, they paid a pretty substantial premium for the entirety of Warner Brothers Discovery. And so now financing, I will say the Ellison family is one that tends to have, a nice track record, but does feel like these various entities, especially the foreign entities, we're going to have to wait and see how those cards do actually fall. But we will leave it there for the top of our show today. Now, coming up next, we'll dive into two casino companies, Las Vegas Sands and Caesars. We'll discuss why one Jefferies analyst is turning a bit more cautious, though, on Las Vegas Sands, which is lower by about 0.9% today. Stick around. Action Investing. We'll be right back.
A non-durable power of attorney terminates upon the principal's death or incapacitation. Non-durable means it does not survive incapacity. A durable POA, would. Life insurance benefits received by name.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
That's three hours.
Intern,
3 hours.
This place is incredible. It's where I get all your office supplies.
Pretty good.
Your golf balls, your fancy coffee, your giant TV.
It's everything in one place. It's like
Schwab. Everything investors need, all in one place.
Come again?
Yeah, at Schwab, they can do everything. Invest, trade, get full-service wealth management, and anything in between.
Think I'm gonna be sick.
We have to buy that now.
Schwab.
Invest your way with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
According to the semi-strong form mode. I don't even know what EMH is.
Welcome back to Next Gen Investing. It's now time for the Chart Master, and we're looking at two casino-focused names today, Caesars as well as Las Vegas Sands. Joining us now is Ricky Cat, of course, our Chart Master, for a fresh look at some key technical levels to keep on our radar here. And we'll start off with Caesars, actually, which was at least the leader of the two today. I know the overall markets are still digesting some headlines from President Trump, but basically now unchanged on the session here. But walk us through the latest price activity we've seen.
Yeah, so up about 11.6% during the past trading year here. In the shorter term, though, we did see this large, strong rally after our last earnings event that began here. So a big push to the upside of about 48.5% from there. But we have dropped off somewhat here. We failed to take out our previous highs here, 31.58. For now, the short-term price pattern is this downward sloping channel type shape here. We are near the upper edge of that boundary. After touching on the 25 level, our green line here that marked a notable series of high water marks here. We did have one close that managed to break beyond that level, but it was not to be. It didn't last. Then that became a stopping point for price to the downside. If you were to keep moving lower, another level that stands out is our relative lows here near the 2350 level. To the upside, relative highs come in near 27, and 28 also stands out. That's around where we hit highs here. That's around where we topped out during our one phase of our rally that was part of our overall decline. That was a notable high point that price struggled to break above. So if we do look at our moving averages that we follow here, our three moving averages, save for our 63-day EMA in gold, our teal, blue and orange are our 5-day, 21-day,
Trading based on
251-day,
insider
all clustered together very closely above 26. So this gives us a confluence point to watch out for.
Well,
A
yeah.
break below that level could be noteworthy in that it would represent a
Right over my
breach of
head.
several
Yeah, I
levels
mean,
that
yeah,
are
if you
converging toward
cheat.
each other. We can also see that our RSI, our measure of momentum, has been trending downward here. It looked like perhaps we were going to break below our 50 midline, but for now, we have managed to reassert ourselves, and we have crossed above this shorter-term downward sloping red
That
trend
was
line
actually
here.
a very
look for
easy
the
question
RSI
when you think
to
about it.
make new
That's
relative
funny
highs
as all
along with
hell.
price for signs of further bullishness. When we look at our
I gotta
volume
really
profile study,
understand
we
the
can see that
questions
the
more.
area at which we
Yeah,
seem
that
to
was
have
a
solidified for now, perhaps,
misconception.
comes close to our
I believe
volume
that's the right way
profile
to
point of
even use that
control,
word.
our thick red line right here, coming in around 25.89. You can see that the volume starts to drop off pretty sharply at 25, which is around where we saw those previous low points that we identified. Things also start to trail off above the 27 level. If we were to keep moving upward, though, there is another pocket of activity here near the 30 level. That would be another potential hurdle for the bulls to clear. When we do start getting below 25, though, not a whole lot to break our fall, really, until we get to around perhaps a 23, 24. That general region could see greater trading activity if it were to be tested.
Okay, yeah, and this name trying to at least regain some footing to go back into positive territory today, but again, looking relatively unchanged, although markets are firming up here at least a bit in real time. So now as we do think through trading this name here, for example, purposes, Alex, walk us through your thinking.
Yeah, my thinking was a lot along what Rick just highlighted there with that volume profile. You're in kind of this area of price supply and a lot of trading action, but if you're able to break through that next level of 30 really stuck out to me. So it's a little bit more of a medium-term trade here, looking for a move towards 30. It's a call calendar spread, Jenny, but it goes all the way out to June. So it sells the May monthly, buys the June monthly at that $30 strike. And with that, if you're able to do that for a 40-cent debit, you have a risk-defined kind of slower moving strategy that looks for sort of that trampoline breakout over time towards that 30 level. And if that happens, this would have a chance to expand and build on that 40-cent debit that you have for this. So the nice thing is, as Rick talked about, you're in that kind of price supply zone where that volume profile had the point of control. If it does break down below that, disappointing earnings, whatever it may be, there wasn't a lot of support below this level. So the risk definition of this strategy would do its work to protect
I'd imagine
against that
it would only be to the
outsized outlier down move because it's risk defined limited to 40 cents. So whether this stock goes from 26, 25 to 18 or just stays where it is, the risk is the same. Where if it does move,
you gotta go through every level every single time. God damn.
Explanation of some of these risk parameters, and now to shift gears.
Yeah,
though,
people
into
are
Las Vegas
using their
Sands,
guns.
Obviously, in a very similar world to Caesars, but I always say one of the most ill-named companies because it has that international
Or like you better
exposure,
hide the
unlike
T.
its name would tell you. But nonetheless, we did see a downgrade today from Jefferies. So shares have been weaker throughout today by about 1%. But walk us through what you're watching for here and how obviously
I can't believe I just did that.
Yes, a pretty different chart in this
We'll
case.
cut that out of the long
Unfortunately
form
for
later.
bulls in
Swear.
this name,
This is the first
much
video
of
I'll
the recent
edit.
price activity has been more geared toward the downside. We hit our high point here, 70.45. From there, you could draw a trend line going across the subsequent highs. Most recently, though, it does seem like perhaps we are starting to push beyond that level. Now, it doesn't seem to have resulted in a big breakout, which is what you might have hoped for if you were bullish. Rather, it seems like we're kind of meandering sideways for now here after establishing some highs near the 55 level. Beyond that, some other notable high points, 57 here, a couple of repeated highs there, as well as 59, which was the high we made after our gap to the downside during our last earnings event. You can also see where the gap began here near 61. Meanwhile, to the downside, 51 stands out. That's about
28 and 30,
another
there's
earnings
ugly
gap.
numbers.
That was where the springboard point began before we went into those highs near 70.45. Notice as well, we never actually filled the gap either. We came close, but we bottomed out a couple times just above 51. So a bit of noteworthy information there that the gap was never actually closed. Another downside point that stands out is 46. That was our high or low point that we had after our gap to the upside, and another subsequent low point here. Our gap also began near that 44 level. When we look at our moving averages next, you can see that kind of a similar situation in some ways here, in that we have clustering moving averages bunched up on top of each other. In this case, they mostly come in near about 54. Our gold 63-day quarterly EMA comes in at 56.31, so that could be another upside boundary to keep in mind here. When we look at our RSI study, a long, steady decline does seem to have been breached along with our price trend line here, but we were unable to make it above that 50 midline as well here. So a bit of a question mark right now. We've still got some time before our next earnings event coming up here too, so perhaps you know, we could see some other catalysts in the works here, but that's the main thing on the horizon that traders may be looking out for near April 22nd or so. Volume profile shows that we are pretty much right on top of our point of control. This area here near 54, that's where our point of control comes in. You can see there's some pretty distinct nodes too. 52 to 56 is where most of the trading activity for the year has taken place. If we're to push to the upside, things thin out here until we get to about 65 with a notable spike at 66. To the downside, there's another much smaller node, but still one that stands out pretty easily here, near about 48 to 50 or so. That general area is where the bulls might look to establish a foothold. From there, though, 40 to 43 is another notable activity area.
Okay, yeah, and also today, again, pulling back about 1% on the session, but markets are at least coming back overall, so we'll have to see if that is able to aid any of Las Vegas Sands' price performance today. But appreciate it to Rick Ducat for all of that technical breakdown. Last but not least, though, as we think through trading Las Vegas Sands, again, for example purposes, Alex, walk us through how you think through this name, obviously similar but still different to Caesars.
Yeah, exactly, and similar but different strategies as well. So this one's more neutral to bullish, looking for this level to hold as opposed for the stock to move higher like we did for Caesars. So it's a neutral to bullish short put vertical spread, and we're going up to May, selling the 50 put, buying the 45, collecting $1. So in this case, Jenny, creates a 4-to-1 risk reward. Both the profit and the loss are defined. You have a max loss potential theoretically of 400, max profit potential of 100, and a theoretical break-even point that can be calculated by subtracting that credit from the short strike. So in this case, that gets you to 49. 50 minus 1 equals 49. So neutral to bullish strategy, looking for the stock to maintain its value as opposed to move higher like we were looking for in Caesars in our example.
And obviously, we have earnings at least coming in these names in the coming weeks, but we still have a bit of time there, so not any earnings imminently, at least for Las Vegas Sands and Caesars. We'll leave it there, though, for Chartmaster today. Coming up next, though, time to discuss another name with some analyst coverage today, that being Netflix, as Netflix did receive an upgrade to buy from neutral at Goldman Sachs. We'll dive more into that note. It's a positive catalyst ahead into
Which
their
retirement
next
account
week,
is subject to them? Dang it.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X.
I'm not going to smoke on test day, obviously.
And connect with me, Nicole
So imagine
Pedalides,
the
on
amplification.
LinkedIn, Facebook, and Instagram.
Or that might be a downfall.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust trading and analysis tools, including over 400 technical studies.
Happy
Tailor the
belated
platforms to your
Easter.
unique needs with nearly endless customization. And track market trends with up-to-the-minute news and insights.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy. It's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern
It's
on Schwab
typically
Network.
funded by a single source and controlled by a board. A private foundation? Yeah.
Download the Schwab Network app and get live coverage wherever you are.
Those statements about discounted cash flow, DCF,
I have a question for you.
analysis
When
are
did
true.
Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He
He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
2 is
Welcome
true.
to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
So, B,
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran
2 and
traders,
3.
and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen,
All
anywhere,
of them, huh?
free. SchwabNetwork.com.
All 4 statements. Oh. I didn't know that.
Welcome
Wait,
back
which
to
one did I
Next
say
Gen
no on?
Investing. It's now time for FOMO, and today we are looking at the move modestly higher here in Netflix shares after we did see some encouragement as far as the sell side is concerned. So joining us now is Jeff Pierce, Senior Manager of Derivatives Trading at Charles Schwab. And so, Jeff, we'll start off with obviously this note. I mean, that was pretty optimistic on all things Netflix. I will also say that they do tend to report in the very early part of the earnings season cycle, so that's next Thursday, I believe. But I mean, walk us through this note and really what stuck out to you as far as some optimism around Netflix.
Yeah, I think analysts are recalibrating after the pursuit of Warner Brothers has ended, and what we're seeing here today with this movement, the price target at 120 from 100 and the buy rating, is the analyst is pointing out that they are expecting a strong start to 2026. They expect Netflix to continue to execute well against their focus areas. They do see a better risk reward as well, with stronger engagement, popular returning content, price increases, and stronger ad revenue. And this analyst believes Netflix can achieve double-digit revenue growth over the next 3 to 4 years, thanks to that ad business and their increasing subscription prices. Obviously, we saw that they recently raised the prices. Premium and standards now going to be up $2.
One of the top hats.
While ad revenue is, ad pricing is going to be up $1. This is a tough time to do this. It's their 3rd increase since 2023. Obviously, there's a lot of streaming choices and. The consumer could feel strained, but the good news for Netflix is this ad-supported pricing gives that lower cost option. And with ad revenue last year accounting for about 3% and expectations for it to count for about 6% this year, it could really help benefit the company overall.
Okay, so Jeff, a big part of this story, of course, was the breakdown in Netflix's ability to purchase WBD. You saw the stock go up tremendously on that news. It seems like they're fully bowed out of that. We're able to kind of get back to assessing Netflix, but the stock's still something like 34% off its highs. How much technical damage has been done over the last 6 to 9 months?
Well, that's what's interesting about the 120 price target, right? If we look from March to October, most of the volume was around 120, 121. Since December, we've been seeing most of that volume around 95. Of course, we saw the stock get down to 75 before it popped on the news that they were, ending that bid for Warner Brothers. Investors are obviously applauding that. The question is now in Q1, can they show that they're going to execute as well as they plan to? We know that they're offering more content like NFL, MLB, those sorts of things. And they plan to spend just about $20 billion on content this year. The price hikes aren't really necessary to cover that, but as they dive further into live streaming, that's something investors are going to focus on. For Q1, investors are really going to be focused on the ad revenue. They're going to be seeing if they're tracking or meeting expectations for the year. They're going to watch margins as well. We know that spending is going to affect profitability. And with operating margin guidance at about 31.5 for 2026, that's already below analyst expectations. So they are not out of the woods yet. They're going to still have to prove that they're able to capture the users that they need while they do this spending.
Okay, and I was curious because, of course, we did have some news that they were further increasing their prices. And this is now a theme that we're seeing, not just in Netflix, of course. We've seen also the prices increase for like Disney Plus, HBO Max, of course. Also, the ownership of that, as you mentioned, was under question for quite some time. But with subscriber growth starting to reaccelerate and then pricing, really, this is a premium product at this point. Are those any degree of really sort of headwinds to the growth story for Netflix, given right now that perhaps we're trying to be more mindful with our streaming dollars? But again, it does feel like the street tends to look at this news as more of hey, you have a premium product like Spotify, you're kind of able to charge more on a monthly basis.
That's right, and it is a risk to raise these prices. But again, that ad-based option gives the lower cost option for users, also gives the company a chance to better to monetize better on those ads and add to margin expansion. If we look at the Q4 report, we did not see a lot of movement from investors after the report, but it was pretty good. They beat on earnings slightly, they beat on revenue. We saw paid subscribers cross 325 million. In full year, we saw that revenue up 16% overall. So I think there is still, optimism that these price hikes are not going to deteriorate that user base. And even though there are a lot of different competitors out there, that Netflix has built a pretty decent moat, and they're expanding into live streaming and sports at a rate that I think users they see a compelling story for them to stay involved with the company.
Jeff, when you think about Netflix and sort of its growth trajectory, I almost put it in three kind of buckets now that are all working together. And the sports stuff, I think, ties into one of them, which is this desire to grow an advertising revenue stream. And one of the easiest ways to keep eyeballs on the screen is have the event be live, and you can advertise directly on that. The other you guys talked about, which is this sort of steady price hikes on the consumers, particularly in the U.S. in a more saturated market. The one that we used to talk about all the time that we don't talk about as much anymore is the opportunity to continue to expand and grow internationally. How important is that last bucket, or are the other two kind of stealing the spotlight right now?
I think the focus area has been on the U.S. ad revenue, the streaming of live sports and other items. But you're right, there is still a lot of ground to be made in terms of international user subscribers. I think what we're seeing is that investors have really been applauding the ad side of this business. We didn't, not too many years ago, we did not expect it to ever come for Netflix. As we've watched users that kind of get in and out of apps as they need them, having this live streaming part does more than just provide a good content library. And so what we're going to see over the next couple of years, I think, is going to be more of an emphasis on expansion as they start to perfect some of these other offerings, including the sports side of the business.
Okay, and as far as some of Netflix's recent performance, I know we all mentioned the fact that we are getting, first of all, a pretty nice breakup fee from that deal not favoring Netflix. And we were saying for quite some time that it was almost like who lost the bidding war actually was the winner. And so Netflix, we haven't really seen that necessarily play out in share price, but do you think this name is just right now too exposed to the overall market? And it really is one of these tech names that is obviously going to be hindered by, again, some geopolitical forces that are weighing on tech right now.
We just talked about this.
I think that's certainly possible that those forces are going to weigh on the name. I mean, seeing that pop since the news of Warner Brothers, I think was in part that investors were glad the uncertainty was gone. It was probably also that they were rewarding them some for their Q4 numbers a little bit. I think this Q1 report, it's pending how it goes, but let's say that they are meeting or exceeding the expectations. We could certainly see investors to continue to reward them. As we said, that 120 marker that we just saw Goldman set the price target to is really where we saw them trading from March to October. So we've been there before, assuming that this Warner Brothers thing moves behind us and they're able to continue to execute on the plan. That number is certainly one that I think investors are going to be watching.
Yeah, and I completely agree, and we will be watching those numbers as they do release next week. So we have some time there, but still we're seeing some favorability for price today. So appreciate it, though, Jeff Pierce, for all of that breakdown and what's really driving, of course, a lot of the recent trends that we see with Netflix. But before we go here, Alex, just to dive into how we think through, obviously, trading this name for example purposes, how do you think through a name like Netflix?
Yeah, optimism abound, it seems, for Netflix right now. It's trying to break out above this $100 level. And say you think that that's possible, I got an example trade that looks for that to happen over the next couple of weeks. Of course, you'll have an earnings event here soon as well, which could be that catalyst that might be necessary. But it goes out to the April 17th expiration. It's the 100-104 call debit spread. So sort of buying an at the money, slightly out of the money call vertical. and looking to structure this $4 wide spread in a way, Jenny, where you're risking a little bit less than your max profit potential. So as structured here, you're risking $150 debit with a chance to make $250. So your break even would be 104.50 or 101.50 rather. So you'll need some help in the market. Let's call it a 2.5% rally from where we're currently at just to break even. But if you do get above 104, for example, in this example's trade, that 150 in risk could be as much as $250 in profit. So a little bit of positive asymmetry, risk defined, profit defined, but you need a rally and you need that to happen over the next couple weeks.
Yes,
Question 140. This would technically be a full-scale mock exam kind of go. 140 questions. And I think we're within 3 hours too. Ooh, it's like, well, let me take this and then we'll see the time. This is actually really good for Monday. Good Monday already. It uses which one uses? I always do this. It's which one uses standard and which one uses beta? I think the trainer uses beta. Yep. Cool. There we go. And we did 109 out of 140. 109 score out of 40. That's good. That is a 77%. That's a pass.
She's got your smile.
Hypothetically.
Carl. Yep, your #1 broker's here.
That's a good feeling.
Little dependent.
Actually, we
all right, and that's day one too. So we're going 7 days a week.
Set up for college fund.
At least 140 questions, 4 hours.
All this Schwab as everything you need is making me cranky.
Well, 140 questions, but then I don't think that we're going to be doing 140 questions.
With Schwab.
Sometimes it's
Stay
going to
connected
be
to
like
what moves
listening
markets.
to
Download the Schwab
videos
Network
and
app
stuff.
and stream live coverage wherever
like on
you are.
YouTube or, I mean, I guess we could do that in the background too. We'll compound it all.
Morning Movers brings
Around there.
traders
Yeah,
the
4
biggest
hours
headlines
and
to start the day,
140
from
for sure.
volatile overnight swings to the
Cool.
earliest analyst calls. Get your watch list
It's a good
ready.
feeling.
8 a.m. Eastern. Morning Movers only
I
on
mean,
Schwab Network.
fuck, it sucks, you know, but it was kind of fun, I guess. There's that little feeling and like
Welcome back to
you're
Next
doing
Gen
something good. There's
Investing.
those butterflies kind of in your stomach, like, and it's a day down. You get excited as you get closer to it. Also nervous, but
which is putting more money back
this is
into
building
pockets,
confidence
but
too.
questions
So
do still remain
yeah.
over how much
Cool.
this really helps at a time of
Thanks
higher
for
gas
being with the
prices
first
and
one.
rising uncertainty. So joining us now
Big
for some more on this is
fucking shit is coming for Move with Reezuhn.
And what it means, of course, for households and states.
If not today,
So thank you so much for joining us today.
I have to make
the
sure.
average tax refund is up nearly 11%.
It's probably going to be today, though. It's big as fuck. Yeah. If not today, later today.
This increase and who benefits
probably today. Yeah, look forward to it.
Sure.
Look for the
So
night. Yeah, look for the move with Reezuhn. It's going to be sick. Big moves are being made.
I think that the ones that the
and then debate with Reezuhn that was already made, but I'm definitely I figured out long form products I'm talking weird like long form videos and all that, some edited videos maybe, but like real in-depth debate breakdowns using the app. Obviously it's gonna be sick.
Yes, it is tips,
and then obviously doing it live too.
A
lot of good shit coming.
Yes, it is.
I just took the weekend and the holiday to chill, family stuff obviously, and then now we're back in action.
Brand new $6,000 deduction.
Thanks.
But the big chunk
catch y'all.